Welcome to another episode of the Australian Retirement Podcast, here with my co-host and good friend, James O'Reilly from Northeast Wealth. James, welcome.
Hello.
How have you been?
Yeah, I've been good. Not as good as you. You've come back from a pretty good holiday. You've got more vitamin
bit of
D
tan going on here
in my body, so you're looking good, mate.
Indeed. It's been a busy few weeks, and we're excited just to bring us all back to reality, to go through a very exciting topic today, which is we hear a lot about the underinsurance problem in Australia, that being people not having enough insurance. But I like where we got a bit clickbaity with the title here, but what happens or what to do when personal insurance premiums get crazy. So as context, and as people probably heard regularly, at Wattle, we tend to focus on kind of closer to retirement and self-fund retirees. So we don't do a lot of insurance. You probably heard me joke around saying we cancel more insurance than we take out, but that's under proper personal advice. James, I know your group has a lot more experience in this area, so I'm excited to host you through this one. And I'm just going to open up.
Hold up, air brakes. No, you've got to tell the people. Like, you've got to tell them, aren't you? You've got to tell them that we have recorded this entire session we are doing this again. Like, this feels like Groundhog Day because we recorded it, but we screwed up how to record it. And we've now got to wade our way through this repeated conversation and we thought we'd hit it too. We're like, that was a good session. We're now going to have to try to do a carbon copy of that.
Recreate that. I'm pretty good at compartmentalizing and completely forgetting what I did over there. So now we get to leave it all again. Hopefully fix up all the mistakes we made in the last one, but we'll see. And I think the best place here is what you're talking about, insurance. Or let's talk about insurance. I often get questions when we provide a client questionnaire to someone, and it comes back with home and contents insurance or other general insurance. So is that what we're talking about here?
Yeah, we're talking about personal insurance, and it can be quite complicated understanding the distinctions. Broadly speaking, you've got a few different types of insurance that people would commonly know. The first is what we call general insurance, and your general insurance is going to cover your house, your car, your stuff. And then we've also got personal insurance. Personal insurance is going to cover you. And of course, the way that it covers you is based on protecting you in the event that you either suffer from an accident, if you're unable to work, or alternatively, in a worst case scenario, you might pass away and there's some money for your loved ones.
Yeah, I think that's the perfect opening. So what we're talking about is insuring your life or your ability to work and earn an income. And can you walk us through how many types of insurance are there, and what are the main types of insurance that we're looking at, and I think and what we should be worried about for, this could be an accumulator or a retiree. And I think a lot of the time these questions come from those that are starting to get into their 50s and starting to look towards retirement, but not necessarily being there yet. So what are those main types of insurance?
There are four, and they all have different uses. But they're ordinarily, if you meet with an advisor, you'll get a combination of multiple insurances. The most common one, which we would all be familiar with, is life cover, or can also be called death cover. I think pretty straightforward what that entails. The next one is called TPD, and that stands for total and permanent disability. And so the concept is that you're unable to work due to injury or illness, but the emphasis in this particular product is around the word permanence. To qualify for a payout, and normally these payouts would be big, they'd be in the hundreds of thousands of dollars, or sometimes often even in the millions of dollars. To qualify for a payout, you'd be getting you'd need a doctor or multiple doctors in some cases, to sign off to say that, in my qualified medical opinion, the person in front of me is never likely to return to work. And there are some different definitions depending on the quality of the product, in terms of, are you returning to work to do your own job, or are you returning to work to stack shelves at Woolies? But the concept, again, is that you're permanently disabled, and that's going to impede you from being able to work ever again.
That's the concept of any occupation versus own occupation.
Yeah, that's right. And the gold standard is own occupation, but the vast majority of Australians have the any occupation definition, because that's what your super fund gives you.
And we can go a bit deeper into that a little bit later. And what's next?
The next one would be what we call trauma cover. Your life insurance, your TPD, and your trauma cover are what we call lump sum covers. And what that means really simply is that if you qualify under the insurance definitions, they'll typically pay you a singular lump sum benefit, which you can then freely use as you see fit. And trauma cover is the same. The difference with trauma cover is that you're not necessarily dying, dead, or permanently disabled. There's a list of qualified medical events. Normally there's 40 to 60 events, again, depending on the quality of the product. And those events are, the common ones are your heart attacks, your cancers, your strokes. And the thinking here is that if you suffer one of those events, your life insurance is not necessarily going to pay. Hopefully it doesn't. Your total and permanent disability cover similarly is unlikely to pay. Hopefully it doesn't. So therefore, what is available for people to get back on their feet, to focus on their health, to take time off work without, like voluntary time off work without having a huge financial impact. And notwithstanding that sometimes, depending on, unfortunately, the event that you suffer, sometimes the best treatment isn't in Australia, and you might want to go and pursue better treatment abroad. And of course, those costs rack up really quickly. So trauma cover would pay that lump sum if you qualify under that definition.
And the last one's probably the most important, and I feel like the one that people hold on for the longest. And we'll get into cancelling and the cost of insurance later on. What's the last one?
Income protection. Yeah. It's also called salary continuance insurance, and the concept of this one is a little different to the lump sum covers because this is an income stream. Rather than saying, yep, you qualify, there's a big lump sum payment and don't come back to us again. It would typically be a case that you say, well, I'm off work due to illness or injury and I've had a reduction in income. And so the income protection policy would then pay you typically on a monthly basis and continue to pay you until you hopefully return to work and your income rises back to where it should be.
I'm going to be a devil's advocate here, and I often get this question, which probably shows a level of understanding in financial literacy in Australia, which is, does income protection pay out if I lose my job?
Most of the time, for the vast majority of income protection policies, no. For all modern income protection policies, no. There are some really good quality ones in ye old times that would have an involuntary redundancy benefit.
Shakespeare.
Yeah, but it's very, very small. No, and the thinking, like from an insurer's perspective, that's fair enough. The reason why I feel that's fair enough is because if you had an income protection policy that did pay if you lost your job, not due to injury or illness, well, then you'd have a really high propensity for people to sign up for that contract when they have a high sense for the fact that that might happen. And so it becomes impossible to price because who knows what the probability is with the people that we're dealing with. And so therefore it's a policy that's avoided by the insurers.
I got another common question here as well. So I'm contributing to my insurance, right? Every year I'm putting more money towards that insurance policy. What happens with my cover? Do I get a payout if I don't, die or suffer some sort of injury? Or
you get nothing. In almost all cases, you get nothing, which annoys me. At a minimum, you should at least get a letter saying, hey,
thank you.
Well done. Over so many years, it could speak to where the money's gone.
You've spent this much money and you've created this much profit for QBE.
Be able to, live their lives and send their kids to good schools and all sorts of stuff. But you get none of that. No, it's just you. While you have the contract, your job, you to honour the contract, you've got to pay the premiums. And the insurer's job to honour the contract is that if you meet one of those qualified definitions for any of the policies that you hold, we're going to pay you.
And so the key there is this is term insurance, that you're covering yourself only for the next 12-month period every time you pay that premium. And I see in so many conversations with clients that even when they get to 60 and they clearly don't need insurance, there's no willingness to give it up because they think they're losing something. They think it's like an old endowment policy where there's an investment component, which I find that one of the mental challenges that people have to get over when they're.
Yeah. Agreed. This is sunk cost bias.
Yeah.
Hey, we're doing a great job. We actually really are copying everything we did in the previous one.
I was going to say that we're doing. I feel like this one's better. I think we're always better.
The concept of sunk cost bias, we've all experienced in one way or another. And the common example I always think of is the idea of waiting for a bus. I grew up in the Dandenongs in Victoria, and so lived in Monbulk for many years. there was a bus on a Saturday that would come at 1:30, 3:30 or 5:30. And if you didn't catch one of those buses, you were either waiting 2 hours or you weren't getting off the mountain for the
I bet you they're never on time too.
It was
1:25.
Yeah, that's right. But the problem was that because I was a young teenager, I didn't have the discipline to say, well, I'll rock up at 1:20 just to make sure that I don't miss the bus. I'd be running to the bus stop at 1:32, hoping that it was still coming. And you'd have that experience of waiting at the bus stop and thinking, I've probably missed it. It's now 1:40, no bus, I've missed it. It's now 1:50, almost definitely I've missed it. But you don't want to leave the bus stop because there is a tiny possibility that as soon as you do, the bus will hammer past and then you will have to truly wait and know that you've missed it. And that happens for a lot of people with finances, even though it might still be a bad deal, even though the whole universe is pointing toward the idea that you either don't need this investment or insurance policy, or you should do something different. I just can't let it go, because if I do, that means that I've got nothing to gain moving forward.
So a trick for me on that one is when you're trying to catch a tram in the city, you walk the same way as the tram line, because they seem to be in massive 10 minutes apart. So that way you can see it coming if you still want to get onto it. But most of the time it's so late that, thanks Metro trams, it's so late that you can walk all the way there anyway. I mean, luckily Melbourne's not that hilly or that big, so I wouldn't be doing in the humidity.
I think the bigger issue was that because the bus came every 2 hours, if you're like, all right, I'll just start walking and hopefully it picks me up, you'll end up walking to the station, which is 11 k's away, before the next bus comes.
Yeah,
which sometimes was the right solution,
sure.
but yeah.
And I think you kind of touched on it in that introduction, but can you talk to a bit more about what each of those policies cover? In terms of not necessarily the use of the funds that would come out of those policies?
Yeah, I'd love to, because I think this might actually be the most valuable part of the conversation. I say that because most people that are listening to this probably have insurance, and I think it's natural with all insurance products. We've got busy lives and you see that renewal letter, and I've had that experience with general insurance before, where you get the car insurance renewal letter and you go, whoa, that's gone up by a bit. And you think to yourself, I got a lot of stuff on at the moment. I'll get to that. I'll prioritize it. I'll review it, but when am I going to find the time? It's not hard to do it, but sometimes that just slips by the wayside for people. It's really common that people come in to see us and we ask, when was the last time you reviewed this insurance? And they say, 3, 4, 5+ years. The purpose of insurance should be for every individual to cover very specific things for you. And I can't stress that enough. The idea of being arbitrary with your insurances, like for example, for life insurance, and saying, what do you reckon, love? $500,000? $500,000 do? Yep. Okay. Let's take $500,000. That's
its finger puts it in the wind.
Yeah, correct. That's a big mistake at both ends. Firstly, $500,000 could be more than you need, and then you are throwing money away. Just a huge waste of time and money, I beg your pardon. But the second thing is that it also could be enormously insufficient based on the mortgage, based on your ambition to send the kids to private schools and the cost you've got there, based on the shortfall if something is to happen to me and I'm not around anymore. Is my wife, partner able to self-fund up to retirement or fund and have a comfortable retirement? Maybe they need more. Those things are very, very deliberate. And when we look at insurance, we're really dialing in for each individual, what do we need to cover? Yeah. More often than not, for your life insurance, depending on the phase of life that you're in, really, really commonly, we want to clear the mortgage. You want some replacement income. In my life, we've got 2 young children. So if I wasn't around anymore, I would expect that my wife, Lou, would not only want to be financially comfortable especially in the short to medium term, but also have the financial room to not have to go to work on Monday and potentially take a couple of years off to say, I'm just going to focus on the kids and their well-being and make sure that they make this adjustment, myself included, as smoothly as I can. I'm a really special guy. Losing me would be very, very difficult. And so with life insurance, and similarly with total and permanent disability, taking that lens of saying, well, if life needed to be more comfortable, obviously with total and permanent disability, you're still around. So you might include some things like, what are my likely medical costs going to be? Provisioning for the fact that often there's home and car modifications that can happen when someone experiences a permanent disability. They're the main things that stand out for the large lump sum covers.
Yeah, for sure. And then it could be medical expenses, funeral expenses, and then funding towards that lifestyle. I think I find it interesting as well that we assume that things won't change, and we can keep going on neuro as an example. But when something major like that, where there's a disability or a death in the family, yes, probably not much will change for the first few years. But at some point, it could be the memories in the house, could be the size of the house. Houses will change, particularly if you're insured younger. Then, sorry, James, but there could be a remarriage. So it's I think, and best. I mean, we actually have to bring up these conversations because in some cases you're insuring for, you have to make some assumptions and they're very difficult to build those into models. So I'm sure you have the same problem. So you have to make assumptions in assuming the continuation of a current lifestyle, but things will change significantly during that period.
Yeah, you're spot on. If we think about those assumptions too, I mean, this is where good quality conversations come in, and getting a real sense for what do people actually want. And often there's a compromise between cost versus what we want. But that's, the role of an advisor is to make sure that people are clear on that.
Thanks for watching this episode of the Australian Retirement Podcast. I'm Owen Rask, the founder of the Rask Group and Chief Financial Officer of Rask Invest. One of the great things about retirement is you get to switch off your active income and move into a mode where you rely on passive income from your investments. This can be a daunting time for a lot of people. In fact, most people in our community will seek financial advice at this time in their lives. So if you're watching the Australian Retirement Podcast, you should know that we have resources to help you find a qualified and vetted financial advisor. To get in touch with one of our financial advisors or partner advisors, you can head to the YouTube description that's below the video and simply click the link to get taken to a page where you'll find lots of resources for finding a financial planner. We've even created a matching tool which matches you to an advisor that we think may be suitable for your stage of life, your assets, or your goals. And you can also find resources on how to verify financial planners and their qualifications. It's all available in the link in your YouTube description. Let's get back to the show.
Now, we led with clickbait, so we have to, and as I've heard a lot, and as we both get comments on the YouTube and the podcast, I said the YouTube, the podcast, and everywhere, the LinkedIn, we get a lot of comments about having clickbait headings and not actually getting to the details. So in this case, we talked about insurance premiums getting crazy. Can you talk to us about I'm sure there's some anecdotal evidence and some, what's the other one? Actual evidence. I've got some anecdotal. You have some actual evidence. But let's talk about the rising cost of insurances. I told you this is better than the first recording. Like the rising cost of insurances, what are you seeing as an advisor? I've picked up some stats from anonymous billboards. And I think there's some stats around attrition, so the cancellation of policies, but also, I guess, the biggest trigger of that, what's happening with the cost of living, and what are you seeing? What are the trends that you're seeing in life insurance and TPD and income protection in insurance premiums?
One of the biggest one is that premiums are going bananas. Insurance premiums are continuing to climb for different reasons. They started to climb quite aggressively. I mean, they've always continued to go up, but they started to climb quite aggressively in around 2020, 2021. And at the time, the insurers' reasoning for that was to say, well, that's because we're not making a lot of money on the interest that we have. So the insurer takes money from a huge amount of Australians. That money all goes into a pool, and then that pooled money, they can just invest safely and get a reasonable rate of interest. And that is helping them to pay out the claims. But then when we went into this low interest rate environment, the insurer said, well, we have to increase fees because we're getting basically no interest on that money that's sitting there in the pool, which is meaning that we're starting to, we're not as profitable anymore. But now we're in a high interest rate environment, and policies are continuing to go up. And the reasoning from the insurers is now around claims and saying we're getting more claims than ever before. And because of that, we need to bump premiums.
Always back self-interest. Have you got any? I mean, it's a quote because it's a quote. That's an interesting point, though. So where are you seeing? I'm probably seeing similar, but where are you seeing the trend in claims? They're saying there's higher claims being made. Is that in? I'm guessing. I'm not going to say where it is. But where do you think
You've got to guess
insurance
now. You
claims
started that sentence.
I mean, it's. I feel like it's obvious, which is in income protection, which is probably almost the most expensive for an insurance company because they have to continue paying that out for an extended period of time.
Correct.
Is it?
And also to add to that, more specifically in mental health related income protection claims. One of the challenges that insurers face with mental health related claims, and indeed, if you've ever gone through the process of underwriting with an insurer when you apply for a policy, if you've ever seen a psychologist, if you've had any what they would define as mental health related matters, they will dial right into that. Ultimately, probably with the insurer's ideal outcome of giving you an exclusion wherever it's justified, and the reason that they want to do that is because a mental health related claim is typically different to a physical health related claim. If I have a problem with my knee that is prohibiting me from doing my role, there will come a point whereby a medical specialist will say with quite high conviction, James, your knee's better. I reckon you can go back to work. But it's very hard for a specialist to make that same declaration if you had the equivalent mental health related issue, because mental health is so complex, and ultimately how I feel as the patient is really the driver of whether or not I should go back to work. So you might have a specialist that says, I think you could go back to work. Everything that I'm seeing indicates that you could, but they don't have the same conviction as they would with a physical injury. And so what happens as a result is that a lot of mental health claims drag on for longer. And so as a result, the costs of maintaining mental health claims are much higher.
Yeah, I think great point. And so we're going back into increasing cost. I've got some anecdotal evidence. You've got some actual client evidence.
There's a few things that really stand out for us when we're sitting down with any new member and talking about their insurances. The first one is that the costs are becoming so significant that you really must review your insurances regularly. I know for sure that there are going to be people listening to this podcast that say, you know what, it has been a while since I looked at my insurance. You must do that. You just must. And there's a few reasons for that. If we look at, I ran some simple quoting for a 50-year-old male, non-smoker in a professional occupation, and their salary was $150,000. We gave them some, I guess what I would describe as fairly standard levels of cover. They had $500,000, $500,000 of life and total and permanent disability cover, and they also had income protection in line with their salary. Now, with income protection, there's waiting periods that you can adjust to depending on your circumstance. You can have a waiting period often realistically as short as 4 weeks. So something happens today, in a month, I'm going to start getting paid by the insurer. And you can also have it all the way out to 2 years if you had a huge amount of, you might have sick and long service leave and money in the bank and so on. And you say, well, I don't need that first 2 years, I'd be fine. And the good news is that then the policy will become a lot cheaper because the risk to the insurer is a lot lower if you have to wait 2 years until you qualify for claim. In this scenario, we assumed a 3-month wait, 90 days, which in my experience for a 50-year-old is hopefully about right in terms of having a slightly more stable financial position than you might have in your early 30s or your mid 30s or early 40s if you bought your first house and maximum debt, some of those other challenges. In that scenario, we observed two things. The first one was that the premium difference between all of the insurers was enormous. The lowest cost premium, and again, to be clear, we're not looking at low quality cover here. We're looking at all good quality options. The lowest cost premium came in at about $6,000 a year, a little bit more, about $6,200 a year, with a pretty large component of that being tax deductible, because as you pointed out, income protection makes up the most of that, and that would typically be deductible. And then the most expensive cover for exactly the same circumstances was $11,000.
Yeah.
So almost double.
That's a huge, yeah.
If you're with the wrong insurer there, inverted commas, the wrong insurer in terms of from a cost,
3 standard deviations,
you're paying double. Yeah. And that's unbelievable in terms of the difference. The second reason, and it's really poignant around this concept of retirement and people approaching retirement, is that your premiums go up at a far faster rate as you are moving into your 50s and throughout your 50s and certainly into your 60s for a couple of reasons. The first one is you've likely held the policy a lot longer. We'll talk in a moment about what the consequences of that can be. But secondly, it's because as you age and you get closer to 65, the probability every year of a medical event occurring goes up, and commensurately the insurer wants to charge you more. And so having a good quality review annually, do I have the right insurance? And also, do I have the right level of cover? Because over the last 4 years, guess what? You might have paid your home loan down quite a bit with extra repayments. You might be in a much better financial position. Maybe we don't have to pay private school anymore. We've cleared that. But our insurance policy had provisioned for a big whack of money to clear the last 3 years of our son or daughter's private school. These are the things that you need to do to audit both the level of cover we have and also are we with the right insurer.
And financial advisors have pretty good tools, which is one of the benefits. We can actually compare almost all the policies available quite quickly and easily. It comes at a cost to us in terms of subscriptions and software, but it's incredibly powerful. So I might play a little bit of game of over under here. You might already have I'm hoping you don't have the notes in front of you. And this is just an example, a randomized example that came out in some research about the premium increase that occurred for I believe it's someone in their 50s. And we'll just say, let's say bands of 10 to 20, 0 to 10, 10 to 20, 20 to 30, 40 to 50. Let's not go specific. How much is a life, TPD, trauma, income protection? None of the cover changed. They just got a year older. What were the premium increases in the previous year for life cover? Which of those 10% bands?
Sure. Oh, just before we play this game, I love this game, but also this game wasn't in the original podcast that we recorded.
It wasn't.
So just to be, I've closed the show notes and I'm going to play this raw. I'd say 10 to 20.
Yeah, spot on. Hopefully you didn't read the notes. And TPD. So this is the cover that covers you in the event of disability. Not for you, for for those listening at home.
I reckon it'd be the same, 10 to 20.
In this case, it was more like 40 to 50% in a TPD cover.
Wow,
significantly higher. Whether something specific changed or that insurer has a problem in their insurance book for TPD, trauma.
Yeah, that'd be bigger. That'd be 20 to 30.
Yeah, spot on as well. You got two out of three, ain't bad. Income protection,
20 to 30.
Oh, just that was in the 10 to 20, but very, very close. And I think what I found interesting here is, as researching that, there was some information from the Council of Australian Life Insurers that said something like 68% of people insured people surveyed, said they'd be willing to give up their life insurance on the basis of given the higher cost of living, and they can't, they'll struggle to afford life insurance, they'd be willing to give it up. 68% they were worried about it, and 23% said they'd be willing to give up their life insurance.
Great data.
To help fund other expenses, which I think is a kind of I don't want to say a blight. I don't want to put it out there and say these big things, but it's highly concerning. And the average attrition rate for insurance, as far as I can tell from all the research in the last kind of 10 years, about 10% per annum. So to see anything high, that's people cancelling a term insurance policy. And there's probably, as you get close to 60, fair enough, but this is for the entire industry. It seems if that went any higher, you'd definitely be increasingly concerned.
Yeah. Another consideration I'd like to add to that, this is that juggle, and it's such a hard juggle at times around where does my money go? Where do I want it to go? One of the really cruel things that happens in insurance is that the people who need it, especially as you approach your late 50s, early 60s, the people who need it are the people that can afford it the least. Yeah. And the reason for that is that if you're in your early 60s and you still need life insurance, it's very likely that you still have a mortgage. It's very likely that you haven't accumulated a lot of investment wealth or anything along those lines. So you're not as far ahead as the person who has paid off the mortgage and cleared that debt and said, yeah, cool, I'm going to turn my life insurance off. So there's this double whammy of not only having to fund really expensive life insurance payments to make up for this gap, but also being further behind because the reason you need to fund them is because you're not in a really strong financial position. It's very cruel.
All right. So with that in mind, how can you fix it? How can people compromise to make sure they can hold on to that life insurance in an environment where the cost for everything's going up?
you need to meet with an advisor. It doesn't have to be Drew or James. But it has to be an advisor that can look at your insurance objectively and look at your situation objectively and speak clearly to you about what do you value and what compromises would you be willing to make? And if you make those compromises, what does that mean to your premium? And where could that money go instead? And that's the obvious thing. An advisor that does that should also be able to run their software, as you described before, to say, well, here's what else is available.
Like switching insurances, reviewing providers.
Assess your health to determine whether or not that's something that's possible. Because, of course, if you're in poor health, you might be, for lack of a better word, stuck with the policy. If you were to move somewhere else, you'll get inferior terms or maybe might not even be able to get that cover anymore. The last thing that stands out to mine is around, so we're talking about which insurer you're with, but then and the compromises on that cover, but also thinking about moving forward. If we look to the next 1 or 3 or 5 years, when are things going to change? When are the moments where we would say, okay, well, your cover level's here right now, but next year it can go to here because of the following, because of these changes in your situation. Perhaps you've got an inheritance that's very likely to come through in the coming 5 years. Well, if you can have if you've got really high conviction on that, that can drive what your insurance premiums are, especially if we're looking at long-term cover. Alternatively, if you're very likely to downsize your home in the not too distant future, and that's something we're totally willing to do, or maybe you and your partner say, you know what, it's not ideal, but if one of us were to pass, it would be better for us to downsize because that would enable us to save a huge amount in premiums. So just being really clear on what life could look like moving forward.
And there's one thing that I think I've used, and you've definitely used at different points, and it is also an area that there's a lot of confusion. So can I hold insurance through my superannuation? And is this a way that we can keep being insured without, amid the increasing cost? And what are the risks of doing that?
Yeah. So you can hold insurance through super, and the insurance contracts have continually evolved, particularly high quality insurance contracts, to give you the ability to hold really good quality cover and fund the majority of it through your superannuation. So there are times when we would meet someone and say, you really do need this cover, but we can see cost of living wise against your salary, cash flow wise, it's just not viable for you to self-fund this out of your own pocket month to month or year to year. So we're going to put a higher component into the super environment, and then that's going to make things more affordable. Now, there are some risks. The quality of the cover inside super is typically lower than that of the quality of the cover outside, but certainly not to the extent where you wouldn't be better having it rather than not having it at all if they were the options that you're entertaining. And also, depending on the insurer, sometimes when you look to make switches like that, even just making simple changes like that can trigger underwriting, which again could create an inferior outcome for you depending on your health and circumstances.
And is there any insurance you can't hold through superannuation?
Yeah, there is. Yeah, your trauma cover specifically. Yeah. Thanks for loading me with that one. Beautiful. And the reason that you can't hold trauma cover through super, it's a good concept. If you suffer a death or you're terminally ill, that will typically unlock your super. So if the money's getting paid to your super policy because you own the policy inside superannuation, so therefore if you own the policy inside super, then the super is the beneficiary of the lump sum. Well, that's okay because your super is going to become available to you, whether you're 62 or 31. Similarly, with a lot of total and permanent disability policies and the types that can be held through super, it's the same philosophy. Your super would unlock regardless of your age if you qualify for a super total and permanent disability benefit. Income protection also is structured that way in most cases. But with trauma cover, it doesn't work that way. If you suffer a heart attack or a cancer or a stroke and you have a reasonable likelihood of returning to work, even if it's a case that you might be spending a few years off work, if that policy is held in your super, that might end up with a scenario where your super was paid, let's say 100 or 150,000 as a lump sum, and you can't touch it because I'm 51 and I don't meet a condition of release until at least 60. So therefore, the government stepped in and said, hey, this doesn't make sense to hold through the super fund. That's not what the intention of the policy is. And it's ending up with people who are super rich, but cash and asset poor at a time when they need more money.
Yeah, I think that's a perfect place to wrap up this episode. So you've given quite a few hints through here. If you had to leave one thing that people should do right now in consideration of their insurance, what would that be?
Think of the date that your policies go through renewal, assuming that you have them, and then set some time. Diarize an afternoon, or like every year, just a recurring thing to say, when this one rolls around, I go through a process of doing a review of my insurances. And hopefully that's done with the support of an advisor, because you'll likely get better outcomes. The way that insurances are structured is that very likely the advisor will be able to offer that review to you at no service, because they'd be receiving a commission as part of your insurance policy. So if that option is available to you, then great. But if not, and you're doing it solo, review, and do it regularly.
And on that note, I just want to thank everyone for listening to this episode. Please continue to send through your comments on the YouTube, on the LinkedIn, on the podcast. Look through the show notes. There'll be links to some information from this episode. And we look forward to doing a few more Q&As in the future. But I just want to thank James for leading us through this highly complex area of finances. So thanks, James. Again.
You're welcome. Thank you so much, mate. I think this session was better than the last one.
100%. I give that last one was a 9. We had this one a 10.
Yeah. Well, like the audience will be the judge of that. But if, in fact, don't even leave comments. Just give us a single digit value. We'd love to know where you thought we went here.
That's all we need.
Right. Thanks, team.
Thank you.
Ciao, team.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.